It's the weekend and you have financial questions that need answering. That can only mean one thing. It's time for Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Well, Happy New Year. Woo! It's exciting. What did you do? Did you make resolutions? Really? Did you? If you did, it's awfully hard to keep them, I know. But this is the program that takes the mystery out of your financial life. We'll keep you on the straight and narrow for that whole conversation around your resolutions. But more importantly, what is it that you want to change about this year? What is it? Is it the way you manage your money? Is it how you look at your investments? Is it that you're finally going to get your act together and get a financial plan, work on your estate plan? What is it? What are you trying to figure out? We'd love to help you. So send us an email. It's very easy. Ask Jill at jillonmoney.com. We start the program with a call, and so today, this first show of 2019 is no different. So today we're on the line with Lee, and Lee, you are calling from Germany, I understand. Is that correct?
I am. Good morning to you.
Well,
afternoon here.
Oh, excellent. What can I do for you?
I'm a military retiree. I did 20 years of service in the military, and I retired 2 years ago. I am now I work for the Department of Defense in Germany, so I'm a federal employee. And I guess I have a kind of a good problem to have, but it's my problem. So I'm looking for advice on what you give military retirees as to how they integrate their pensions into the traditional programs, 401ks, Roth, TSP, and the government case. So
you are 20 years that you gave of your life, which is pretty awesome. And you are currently receiving a pension of how much, Lee?
It's about 50
grand. Okay. And then how much are you earning as a federal employee currently?
About 110 to 120, depending on the exchange rate.
Uh-huh. As a federal employee, are you participating in the thrift savings plan?
Absolutely. I max it out.
Great. Fantastic. When you look ahead, what's the game plan? You're how old right now?
So I'm 45. The game plan is I think I'd like to try something non-traditional probably in 5 years. I know you say I need to do something, which I know I need to do. But
I'm not saying you have to do something. Wait a second. Let's see how much money you have. I mean, if you're worth $10 million and you never have to work again, you can do whatever you want. I'm totally fine with that. How much money is in your thrift savings plan right now?
About two and a quarter.
Okay, so about 225 grand. And do you have money outside of retirement?
Yeah, I got about 175 in a Roth, or in different Roths, but collectively in a Roth. About 350 in mutual funds, mutual funds in ETFs and some individual stocks.
Okay, great. That's fantastic. Are you single or married?
I'm married. My wife's British, so she's kind of under a different system. So I don't really. Well, I mean, obviously she comes into the retirement, but for tax purposes, she's a different entity.
She's a different entity, and she loves scones with clotted cream, and so do I. By the way,
who doesn't?
How old is your wife?
My wife's a few years older than me.
Oh, very nice. So let's call it 48. Do you guys have kids?
We do, but they're gone. They're working.
Okay.
So
on their own.
They're not a burden anymore.
Not a burden. I think you mean we've done such a fine job that they are completely independent. I think that's what you meant. Okay. So
there you go.
how much, now that the kids are gone, this is a great question for you, which is how much money do you think you'll need to live on? Let's pretend it's 5 years from now. Okay. And what do you think you need in terms of your living expenses?
So as I sit here in freezing cold Germany, and we're off on our way to Singapore and Bangkok in a week to get away from here, I think I need a couple trips a year. Or a couple trips and some skiing, so reasonably maybe 20 grand. Mm-hmm. Our house is paid for, so we're good with that. And then I need some cost of living. So I'm thinking 80 to 100.
80 to 100. Okay,
few,
let's say 100. Let's say 100.
10 years.
Let's just say 100 because that's like a better number that I think is more realistic. Okay, so you're going to have half of that, right? At age 50, you know you got half of that covered, right?
Hopefully, yeah.
You definitely do because you have a pension. So,
Yeah.
I mean, that pension doesn't stop. Okay, what are we going to do to get the rest of the other 50 a year? Are you going to tap into your mutual funds and exchange traded funds?
I don't want to. I know at 50 and a half I probably need to start doing something, but that's not for 15 more years. So
right.
I'd like to not have to do that if I don't have to.
Mm-hmm. Then how are we going to have you spend that $100,000? Are you, in other words, are you saying to me in 5 years you want to do something completely different that you would make $50,000 a year doing that thing?
Potentially.
Here's what I think. I think you could do that. So if you said to me, look, I'm 45. Don't give me grief, Schlesinger, because I want in 5 years to live a different kind of life. I am totally there with you. I'm not going to tell you not to do that. What I am going to say is this. At age 50, you know you have $50,000 coming in. Between you and your wife, come up with another $50,000 a year doing something. And I don't know what that thing is. And leave your money alone because you're going to no longer have the money to contribute. But you are. I mean, look, you got $750,000 socked away already. All right. And presumably you're going to keep saving. So I think in 5 years, hopefully you'll have $1 million generally. Right. You have $1 million.
Yep.
And if what would be wonderful is at age 50, you never touch that $1 million. And that money could essentially grow for 10 more years without you dipping into it. And if that's the case, then I think you're really going to be fine because, if in 10 years your million, if you don't touch it, grows by some nominal amount, 5-6% a year, let's say 5, okay? You'll be in pretty good shape. You'll then at some point be able to collect Social Security. Your wife's going to get some sort of something from the British government. You have your $50,000 in your pension from the military. You'll be fine. But here's when you're not going to be fine. If you tell me that in 5 years, you're going to start blowing out of those mutual funds and exchange traded funds and stocks, that $350,000 in post-tax money, if you're telling me that's the case, then I don't think the plan works. So you got to be willing to do something at age 50.
Right. Makes sense.
I mean, look, I think you're in amazing shape. I really do. So obviously, every year longer you work, the whole plan works better. On the other hand, I just want you to understand that your biggest risk is dipping into your nest egg too early in your life because hopefully you're going to live till you're 85, 90, 95 years old. And if that's the case, we got to make that nest egg absolutely work. Okay? How's that sound?
Very helpful.
All right, good. Go get them. Tell me what you're doing in 5 years. All right, we'll get back to more of your calls and more of your email questions in just a second. Hey, we've got exciting news. We've got a new podcast, a relaunch. So our podcast, it's called Jill on Money. Just like this show, it's a little bit different. We're making some changes to it, all based on input we receive from radio listeners and podcast listeners. Go check out Jill on Money anywhere you get your podcast, Apple, Stitcher, radio.com, Google Play, anywhere else. That's where you'll find us. Just search Jill on Money. Okay, we'll be right back.
If you've missed any part of the show or want to check out a past show, go to JillOnMoney.com for more great personal finance content.
You're back with Jill on Money. If you've got a financial question, we'd love to hear from you. Our email address is askjill@jillonmoney.com. Okay, so listen, it's a new year. It's a new you. Everything. I got it. But the reality is part of looking ahead is also about looking back. So this might be a very good time for you to look and see how you did last year. And I'm not saying just your investments. I mean, overall, what are the good things that happen in your financial life? How can you really try to replicate some of your wins? What did you do well? What did you not do so well? Some of this stuff around money is about habits, about good habits. It's about trying to make sure you avoid falling into traps. And so that's where we can help you out. Even if you have fallen into a trap, now is a great time to figure out how you get out of it. And we are there. We are like your emergency exit. We will pull the string for you and help you get out. So just give us a holler. Ask Jill at JillOnMoney.com. Right now, we're going to take another question. It's Mitch from California. Hi, Mitch. Welcome to the show.
I just turned 50, and I'm thinking about retiring early.
Whoa. What do you mean, turning 50, retiring early? Why?
Yeah. Well, it was just a dream that I started having a few years ago, and I just kind of started lining up my finances to make it possible. To be totally honest with you, I'm not sure what I'm going to do, so I'm kind of waiting to pull the trigger until I kind of figure that part out.
Okay, but wait a second. Like, do you hate what you do?
No, but you know how it is. Like, Mondays come around, and you're like, oh, God, do I have to go to work again?
I know. It's really, it's unrelenting. But but the thing that's interesting is, considering how long we live, and you're 50, you essentially could say live for another 40 years. It takes a lot of money to be able to just retire. Do you think, when you imagine this blissful state of yours at age 50, does it mean never working again, or doing something different and making less and working less hard? How do you imagine that?
I do want to continue to work because I like working,
Okay.
But I just kind of don't want to work for other people. I think maybe that's where I'm going.
Yeah, well, I am all over that. So tell me about you and your life. Are you married, single, partnered? What's up?
I've got a partner, no kids.
No partner, no kids. And how much do you earn right now?
I'm earning in the mid-300s.
Okay. Tell me some more stuff that's going on. Like, how much have you saved so far?
I think not including the equity on my condo, I've got about $1.4 million.
That's great. That's fantastic. That's awesome.
Thanks.
Okay. All right, and you're maxing out, and you work for somebody.
I'm maxing everything out, yeah.
Okay.
At my salary, if I don't max out on my 401k, the taxes are already horrible. So
this is all good news. How in the breakdown of what you have saved, what have you saved in retirement versus outside of retirement?
So I started saving quite late in life, and my retirement accounts are relatively low comparatively. I've got about $860,000 in taxable accounts. Also, I've got an emergency account worth about $90,000.
That's good.
And then my taxable tax deferred accounts, I got $150 in a 401k, $30,000 in an inherited Roth, $63,000 in a Roth IRA, and $170,000 in a rollover IRA.
Okay.
Now, one of the things I wanted to ask you about was that rollover IRA, because when I read the blogs about early retirement, they always talk about backdoor Roth conversions.
Let's project into the future. I'm not saying you're going to retire, but because I want to just say, like, you want to do something different. Let's just say that you go from the mid 300s, and you're now going to make 150. So instead of being in the 35% tax bracket, you drop down to the 24% tax bracket. Why is that important? Because then if that money is sitting in your old plan, you can start to take money out slowly but surely and convert it into a Roth at a lower tax rate. What could you live on?
I live on about 60 or 70 right now.
Get out. That's great. All right. So let's just say that you make 100. Let's say you make 120, right? And that'll pay your bills. Okay. Whatever you do next. If you were making 120 as a single, you'd be in the 24% tax bracket. And maybe what you would do is that, every year for the next 10 years that you make 150, you convert 30 grand of your old retirement account. And you stay within the 24% tax bracket. And now you're paying a 24% tax because I think that in the future, you don't know what your tax bracket's going to be. I do know that 24% is pretty low. I love the idea of converting a chunk of your money into a Roth asset. It's the best asset out there. I can't believe it's still actually legal to use a Roth IRA because I think they're so good. It really is amazing. Yeah. Can you live on $120,000 a year? That's the answer. Yes, you say. If you have $1.5 million or so, or 1.4 million, one way to think about what you can use from that account is in your mind. You could say, generally speaking, I should be able to take out 3 or 3.5% of that a year. That's about, let's just call it $45,000 a year. So that's what you can assume from a nest egg of 1.4 million. And you'll get Social Security eventually. And if you keep working and you're willing to drop it down, if you can live on that 120 a year, then I'm not going to call it like retirement. I'm just saying that you're going to have the opportunity to do what you want to do. And if you can just do what you want to do for another 10 years, I think that's pretty great. The alternative is you kill yourself for like 5, 6, 7 more years at your 350 or so, and you keep piling in the money. And then instead of, you're looking at retirement, instead of at 50, you say, I'll just do it till I'm 55 and then reassess there. But it really depends on how awful you think your life is right now. That's the question I have for you. And if it's not that awful, it's like, Sunday nights suck. How do you feel about that? How do you feel about this game plan?
Listen, I have a very good life. I mean, I have a lot of blessings in my life, so I'm not complaining. It would be nice to get a little time back,
Yeah.
A little control back.
I get that. I think that you're on track for being able to do that. I think it's really a question of what you can do. My fear is, I have a friend who retired. She was worked at a huge big bank. And she's like, I just don't want to work quite as hard. And I was like, I get that. So she did the same thing. She's like 49. And then she ends up taking a job where, ostensibly she's not making nearly as much money, but she's working just as hard because she only knows one way to work. So the only thing I would caution you against is that you're not signing up to be the same animalistic worker that you are right now for a lot less money. And it may be different because if you're working for yourself and you feel really good, it may not feel like the same kind of work. But I really caution you that many people who are just wired this way don't know how to work any other way. Mm-hmm. And if you're one of those, then I might just keep collecting my 350 G's and work my butt off and get my benefits and keep killing it and then reassess.
That's a good point.
I'm sorry. It's just
okay.
Some of us are wired that way. I will tell you something. My personal experience, my own life, I worked so hard when I owned my own company, and I really thought I'll never, ever want to work that hard again. And I work just as hard now. But because I don't have employees and because I don't have to manage anyone, it's way different. So I work just as hard, but I love what I do so much more. And most of that has to do with not being part of a company. And it's just me. All right. We will get back to more of your fantastic calls in just a second. We're going to go pay some bills during the break. Go to JillOnMoney.com. And there you can sign up for our free weekly newsletter. We'll be right back.
Welcome back to Jill on Money, where Jill Schlesinger takes the mystery out of your finances.
Well, it is still the first weekend of the new year, 2019. So amazing. How time flies, or as my mother always liked to say, tempus fugit. We are delighted that you are with us here in 2019. And as always, we'd love to hear from you. And this is a great time of year. Once you've gotten those resolutions about how much weight you're going to lose and how much you're going to go to the gym, basically you're going to become Mark Talercio. How you're going to become the specimen that is Mark Talercio, who is so disciplined, spinning on his Peloton bicycle. Peloton is how you pronounce it in Espanol. And isn't that what the Peloton? I think the Peloton is the little ball in Highlight. Go check that out. That would be amazing if that were the actual, if I remembered that correctly. There's so much stuff that is in my brain that is crowding out the capacity that I need. I need like to store some of this old, ridiculous stuff on the cloud somewhere so I can free up some cells. Check it out. Peloton. I believe that's how you pronounce it. Okay, here we go. Let's get some of your questions. Marianne writes that she is almost 91, living well. She has savings of about $25,000 or so. She said that she has an estate plan that she did 21 years ago, and she established a revocable living trust, but it has not had a single adjustment since the last 21 years. Almost everything in it has changed. I've been a widow for 10 years. I no longer have any real estate. I moved from New Mexico to Minnesota, where I live with my youngest child. The attorney who established our trust died. Never a good sign when you outlive your estate attorney. And the person who did the trust died. Where do I start to get a handle on things without it costing me thousands of dollars to get it straightened out? I get income from Social Security and a retirement account from the state of New Mexico, where my husband was a state employee. She makes $2,000 a month. Living expenses, about $600 a month over that. She pulls the money from savings. She still drives, by the way, 91. She's driving her 19-year-old car. Wonder what kind of car that is. Want to have a bet? I'm going to guess. Let me put my guess in. Toyota Camry. What do you think? That's a pretty good guess. Anyway, I don't know, like driving at 91. I don't want to be driving at 61, let alone 91. So God bless. Let's see. She wants to talk to someone face to face. She lives in Minnesota, a small suburban city, about 20 miles northwest of Minneapolis. Here's what I would do. I think that you can go, you're not going to have to spend thousands of dollars. You need a simple will. You need a simple will. And you probably don't even need a trust anymore. But someone has to do this. And so what I would do is I would make an appointment with you and your child, and you need to find someone in Minnesota, and maybe your kid. What's your kid doing for estate planning? Maybe you can both do your estate planning together. Get the name of a couple of lawyers, maybe a young lawyer who can just do, again, something simple for you. And it does make sense to pay for this because it's a legal document. And it's not going to be thousands of dollars, but it could be $1,000. How about that? I wonder if I know anyone. I'm trying to think. Do I know? I don't think I know an estate attorney in Minneapolis area. But what I would do is I would just ask for some referrals and help you and get your kid involved also. That would be helpful. So good luck with that. And yeah, go get some help. All right, here is a message from Tom, who's 62 and married, and his wife is 61. He says, I plan to retire shortly with a pension of $2,500 a month. After retirement, my health care will be paid by my employer until age 65. My house will be paid off this April. $665,000 in a 401k. Probably about $700 by the time I retire. My wife's 401k, $50,000. $70,000 in an IRA. $58,000 in a Roth. Married, no kids. Buffalo. I'm wondering if I should take Social Security at 62 or at my full retirement age, which is 66 and 4 months. This is the thing. When possible, and I think you got this easily can be accomplished, you want to wait till your full retirement age. You've got money. You do have money. And so, especially because your wife is he writes that my wife's going to collect half of my benefit, because it's both of you that are pegging off of this Social Security claim, you really have to wait till your full retirement age to maximize it. So I think that so a couple of things. Number one is that obviously if you could work a little bit part-time and maybe use some of that money to pay for your costs to supplement the pension, that would be great. But if you had to, taking money from your 401k for 4 years, that would work. And I really think that you may actually benefit from working with somebody who can help you manage this. I mean, if you've got $2,500 a month, we're really talking about $2,500. Hold on, I'm looking at this. $2,500, $2,800, and then she gets half of yours. So you're pretty close. Yeah, I think you're going to have to delay this. And by the way, if I could encourage you to do so, as I said, if you can actually do a little part-time work, Tom, while you're delaying that Social Security benefit, you or your wife, that would be fabulous. But yeah, you can pull money out of the retirement account, dribble it out, and use that. And that will make sense for you. And you can pay the tax due. And hopefully the tax bracket is pretty low for you relative to what you are already making. What's the best case scenario, Mark? He keeps working. Exactly. Don't retire yet. No one likes that advice. So I'm going to stop giving it. It is the right advice, though. I'm just looking at this article. I also read this article here where I love this. It says, why you shouldn't retire when your spouse dies. I think why you shouldn't just retire at all. Unbelievable. There is a recent study that found that just extending your work years by just 2 to 5 months can offer the same payoff as saving an extra 1% annually over 30 years. Bottom line, keep working. Keep working. Keep working. All right, you're listening to Jill on Money, where we love to work because we love what we do. And if you've got a question, we want to hear from you. The email address is askjill@jillonmoney.com. When we return, more of your questions. We'll be right back.
Follow Jill on Twitter and Instagram for more personal finance content. Just use the handle @JillOnMoney. Now, back to the show.
You're back. It's Jill on Money. It is the beginning of January. And what are you doing to change your financial bad habits? What? What are you doing? Are you stopping some bad behavior? Are you starting some good behavior? Here's one way to get off on the right foot. You can go pre-order. My book comes out in just a month. My new book, it's called The Dumb Things Smart People Do With Their Money. The Dumb Things Smart People Do With Their Money. You can pre-order it on our website, JillOnMoney.com. And you can pick your poison wherever you want to buy it from. Lots of links there. Okay, if you've got a financial question, yes, we want to hear from you. Just send us an email. Ask Jill@JillOnMoney.com. That's what Philip did. And he says, consider these scenarios. First, a person is retired alone, 65 years of age, and has $1 million to invest. Financial planners will advise that he should invest 65% in bonds, 35% in stocks, adjusting the balance each year with age. Further, assume he is withdrawing $40,000 a year, plans to continue forever. That 4% guideline we often hear. Now, assume the same situation, with the only change being the amount to invest is $100 million. It may be safe to say if it was all invested in stocks, the person will not run out of money and the rate he is spending. Question: how much money does someone need so they no longer need to invest in bonds? What's the math behind the assumption that a person should invest their age percent in bonds and the remainder in stocks? It's really the same question, he says. What's the math to find the level of investable money needed for stock investment only? Let me know if you need more detailed assumptions. I wonder who this person is, who he asks about, my friend. Okay. Big picture. You got a chunk of money, and the allocation split is not a formula. The kind that you're noting is sort of an old wives' tale almost. It was a back of the envelope way so that financial journalists could just say, oh, this is how much money you should put in stocks versus bonds. Take, your age minus, take 100 minus your age, and that's what you should put in stocks. I think that is complete nonsense. So let's go backwards. Let's say we start with the premise that you start with, which is I need, and this is where everyone should start. Figure out, number one, how much money you need to withdraw. He says $40,000. And he says, I want to pull $40,000 from my million, which is what had previously been called the safe withdrawal rate, meaning it's the amount of money you can take out of your portfolio today and hopefully not run out over time. But I think that that's a high number. It's really closer to 3 to 3.5%. And it doesn't necessarily factor in that 40 is going to have to be increased with the rate of inflation. So, yeah, you might hear me talk about 3.5%. But, the problem is that these are estimates and you have to be flexible. You also have to consider what exactly is your comfort level with volatility. So I would suggest to you that if I had $100 million and I didn't really care about growing my portfolio and I just wanted to live off of it, I might put the whole darn thing in treasuries just for the heck of it. Let's say I had no heirs. Let's say it was just going to go to charity. I would basically put the amount of money I knew that I needed in a fixed investment to give me that money every year, and then I could let the rest of it fly. But again, this is a very tricky conversation because it's not a set formula. There are some advisors who I've talked to, and I think they could be right, that the reality is that most people it should be on a sliding scale how much money you withdraw from your portfolio. In a really robust year, the market's growing, it's going great guns, you might be able to take a little bit more, maybe up to 4%. But in a crappy year, maybe only take 2%. In other words, there's a lot of different ways to skin this cat. And so my feeling is that generally the math goes like this. What is the rate that I can count on over time to provide the income I need? And how do I achieve that rate of return? With what blend of portfolio? What is the diversified asset allocation that will get me there? If I hate risk and I can put more in bonds and still get myself there, fine. And conversely, if I really don't need the money and I'm kind of investing in perpetuity, kind of like the Warren Buffett, like he sort of says he's investing with an unlimited time horizon. If that's you because you have so much money and really all the money is being invested for your grandkids or your favorite charity, then you could be 100% in stocks. But it really does depend on you and your risk tolerance, your needs, your security, what else is going on in your financial life. So that's what I'm telling you, Phil. His name is Philip, but I called him Phil. I don't know. Hopefully that's okay. Sorry about that, man. All right. What do we got here, man? Less than one. I can't do this question then right now. Okay. So when we return, I'm going to do a quick little business here. A little more of your questions. If you've got a financial question, you want to know safe withdrawal rate for you or an asset allocation for you, give us a call. Nah, don't give us a call. We're not even answering the phone anymore. Send us an email. Ask Jill at jillonmoney.com. We'll be right back. You are back with Jill on Money. And before we close out the hour, I want to respond to an interesting email we received from Andrew, who's 52, married, and he's in career transition. He's asking about robo accounts or online investment advisors. He says, I know that one of them is a sponsor of your podcast. And he opened up an account with Betterment, which is the podcast sponsor. And he wanted to just sort of test it out. And he says, I'm a do-it-yourself investor. I have been my entire life. Should I keep the robo account open? I like it more than Schwab because of the tax loss harvesting. It offsets that. Harvesting probably offsets the 25 basis point fee. So, okay. So keep it open. Maybe move some more money in there if that's the case. My home's fully paid off. No debt. Kids' college is done. Wife and I have $1.6 million in Roth and regular 401k, 403b, 400 grand in a robo. So I can do that math, Mark. That's $2 million. And then he's got another $2.5 million in bonds and cash and $2.9 million in some equity funds. So 4, 6, 7. Well, that's a good number, huh? What do you think, man? I like it. $7.5 million bucks. This is question 2. He's got a bunch of corporate bond funds and some international bond funds. Question: does it make sense to own funds, or should I be sticking to owning actual bonds? I think with your level of assets, I think you should stick to individual bonds, because then who cares about the fluctuation? You hold it to maturity. It's probably more efficient for you, actually. So, yeah, I think individual bonds. Question 3. He thinks they spend about 125 to 150 grand a year. I'll say 150. Wife works part-time. She makes 65 grand. I'm deciding between early retirement or working part-time. Do you think, given our high spending rate, I should work another 5 years full-time or part-time? You're young, man. 52. I'm going to say work. I presume that if you run the numbers, you can somehow figure out how to make the money work on $7.5 million bucks. But I think you should work, and I think you can do it either full or part-time. But the longer you delay invading that money, the better off you're going to be. Plus, I think it's better for your brain. How about that? All right, Andrew. Let me know if I'm wrong on that. Thanks, everyone, for listening. For this hour, we have a exciting, chock full of next hour coming right up. So during the break, hop on to JillOnMoney.com. You can catch some of our recent blog posts and videos. We'll be right back.
It's the weekend, and that can only mean one thing. You're listening to Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome. It's hour number 2. We are broadcasting live from the Capital One Bank studios. Thanks so much for joining us. I always like to have a guest in the second hour, kind of warm up with you. It's like we're stretching, we're doing a little light jog, take some questions. Mark's doing some jumping jacks right now, which is impressive at this time in the morning. And we just want to make sure that, you're ready to go, because we have a very great and special guest. You want to get your new year off on the right foot, right? Here we are. It's 2019. One important way to do that is to understand how the markets move. And they do move in big cycles. And that is why we have asked Howard Marks to join us today. He is the co-chairman, co-founder of Oaktree Capital. He's written a book called Mastering the Market Cycle. I know it sounds like he's doing market timing. He's not. This guy's been in the business a long time. The way he invests is quite applicable to you and your long-term investing. So here's our interview with Howard Marks. We started the interview with why he left Trust Company of the West and why he started his own company, Oaktree Capital. Why did you do that? I mean, you had a great career. What did you see that was going on in the 90s that made you want to do that?
Well, first of all, the funny thing about our business is if you reach a certain stature, you can go out on your own and the house doesn't get their share. So we were working for the minority of the fees. Mm-hmm. That was number one. Number two, we wanted to have a firm that ran our way. We have very definite ideas about how to run money, and over there, they ran money every which way, depending on the strategy. And when I became president over there, I was uncomfortable fronting for approaches I didn't agree with.
So what are those approaches that you founded this company with? Tell us a little bit, because this has to do with your book as well. So Sure. What is the approach that Oaktree took that was maybe different than where you were?
Well, all we did is we continued to run money as we had. I write. So we sat down and wrote out how we had been running it, and that became Oaktree's investment philosophy, which we still follow today. And the key thing about Oaktree is that all of the strategies follow the same philosophy.
And which is?
6 tenets.
Okay.
The first one says that the most important thing for the money manager is not making a lot of money. It's not beating the market. It's not being in the top quartile. The most important thing is controlling risk. And, we are in risk-prone sectors of the market. We don't do high-grade stocks, high-grade bonds. We do alternatives.
Right.
And I always thought that the best formula was to be the low-risk manager in high-risk asset classes.
How do you do that when you're in those high-risk areas?
Well, in each one, there are different ways to do it. But, for example, in high-yield bonds, which is where I started at Citibank 40 years ago, we buy single Bs. Now, in the last 10 years, the people who bought triple Cs and on down made more money. Mm-hmm. But I think it's more uncertain. And the clients who come to us want a high degree of reliability.
So you think that controlling risk is your first tenet.
Yes.
Can you compare that with the way that many managed funds do look at their, whatever, maybe they don't even have articulated tenets, but it seems to me that everybody's like, well, I just want to beat the market.
Right. Well, I think that's right. I think that for most people, beating the market is the most important thing and maximizing return. I believe that it's not important to beat the market when the market does well, which is most of the time. Our clients want to beat the market when it does poorly.
Right.
And if we can deliver, let's say, average return in the good years and above average returns in the bad years, we will have above average returns overall, below average volatility, especially good performance in the bad times, which is when I think you need it, and happy clients.
In addition to managing risk, what's
Number
the second
two is consistency.
Okay.
We and our clients don't have the objective of being in the top 5% of money managers in a given year, and we're unwilling to be in the bottom 5. They want consistency. Number 3 is we are only active in the less efficient markets where we think hard work and skill can pay off.
So that's really interesting. I just want to interrupt you for a second because I think a lot of people who listen to this show, they hear me talk about why are you buying a U.S. growth fund when you could buy the index?
Yes.
Explain what your decision and why that decision is different and what those markets present to you.
My first 10 years at Citibank were spent in the equity research department from 68 to 78. I ended up as director of research for the last few years. And then I was moving over to money management, and the boss said, what do you want to do? I said, I'll do anything except spend the rest of my life choosing between Merck and Lilly. I mean, there are such a thing. I went to the University of Chicago in the mid-'60s when they were just starting to talk about market efficiency. It's a concept that was developed there and taught there. And market efficiency basically says that if everybody understands a market, knows about it, has the data, is highly motivated to participate, and so forth, that their efforts will drive out of existence all the bargains, and everything will end up being priced fairly for the risk.
Right.
I believe in the concept of market efficiency. I don't believe that any markets are fully efficient. But as I say, I don't think you can, if you said to me, you can work here for the next 50 years, and if by the end of it, you have chosen successfully between Merck and Lilly each year, and you get a $10 million bonus, or otherwise you get nothing, I don't think you could do that.
Right.
It's like being a professional coin tosser.
So where do you think that there is market inefficiency? If the U.S. large cap market has some semblance of efficiency, and you're probably better off buying an index fund,
right.
Where are the places and what parts of the market do you think that there is still inefficiency?
Well, we're active in non-investment grade credit, which means high yield bonds, leveraged loans, direct lending, private lending, mezzanine finance, and things like that. We're active in real estate and real estate debt, infrastructure, emerging markets, Japan, anything off the beaten path. Now, some of these have gotten more efficient than they used to be, because if you think about it, knowledge is cumulative. People learn things. Once they learn them, they basically don't forget them. So there's a kind of an upward ratchet. And, now, especially with all the computer power, the internet, and all that kind of thing, there's kind of no such thing as not knowing something anymore. You're sitting at dinner, you say, I love that movie. What year was that? And within 2 seconds.
I know. We used to scratch our heads saying, and we spend the entire meal, and then you drink a little more, and you really have no idea what the question was to begin with.
Exactly. But so it's tougher. Everybody knows more today than they used to know.
Are you guys willing to be short sellers when you see a distortion that way?
We're not that big on short selling. Short selling is very tough. Name the famous successful short sellers.
Jim Chanos.
Okay,
Maybe.
And the others?
I'm thinking.
All right, get back to me.
When I was on the floor, I felt like short sellers did incredibly well because it was like an hour-to-hour
Yes,
short,
right.
right? Like I went short until 2:30,
Right.
and then I covered and I went home and I made a few bucks.
But that's what I call trading.
Right.
That's not investing.
No.
And I don't know anything about trading. In my world, in my experience, trading is what you do to implement an investment idea. You want to buy a certain bond, you call the traders, you say, see if you can get me $10 million.
Right.
But you're not doing moment to moment or day to day.
Okay, we will get back to our interview with Howard Marks in just a moment. But during the break, here's what you can do. Hop on to JillOnMoney.com, and what you can do there is just sign up for our free weekly newsletter. Do it, JillOnMoney.com. Okay, we'll be right back.
Back to Jill on Money, where Jill Schlesinger helps you take the mystery out of your finances.
You're back with Jill on Money. If you've got a financial question, an investment question, a tax question, why don't you send us an email? It's askjill@jillonmoney.com. Askjill@jillonmoney.com. A lot of you throughout last year were starting to get worried about bonds, rising interest rates. What would the impact be on bonds long term? And, I think that's a very good question. It doesn't mean that you should be avoiding that asset class altogether. So as we pick up our interview with Howard Marks, the co-chairman and co-founder of Oaktree Capital and the author of Mastering the Market Cycle, we're going to get into a conversation around bonds. Don't fall asleep. I see your eyes rolling back. This is actually important, so pay attention. And if you have questions about your own bond holdings, of course, you can always send us an email at askjill@jillonmoney.com. But listen to this first and then send us your questions. How about that? Here's more of our interview with Howard Marks. You hear a lot about these debt markets as being, I've interviewed a couple of economists recently, and they continually point to some of the dangers in the debt markets right this minute. Mm-hmm. And whether it is the actual junk bond market, whether that means the leverage loan market, which is not exactly a bond, but it sort of smells like one. And Janet Yellen was recently quoted in the Financial Times saying that this is a huge risk. Mm-hmm. What is your view on that side of the marketplace and what risk is prevailing now?
7 worst words in the world: too much money chasing too few deals.
Yeah.
And I believe that that is definitely true of parts of the debt markets. There is pro-risk behavior going on. And to me, the word pro-risk is a very negative word.
Right.
Because Buffett says the less prudence with which others conduct their affairs, the greater the prudence with which we must conduct our own affairs. And when others are behaving in a pro-risk fashion, it makes the market risky for everybody. In the debt world, if there is too much money chasing too few deals, then the auction, every market is an auction place. And the auction gets too heated. Mm-hmm. And if too many people have too much money and too much eagerness to invest, what happens? The price goes too high, which means the prospective return goes too low and the risk goes too high. I would be surprised, Jill, to see this market go the way of the global financial crisis with the subprime mortgages. I don't think that the organizations doing the investing I'm talking about are systemically important, and I don't think they're doing it on the same kind of leverage. What's the problem? The problem then is that when the auction is too hot, people get money they shouldn't get on terms they shouldn't get, and that means that in the end, some investors will end up having taken more risk than they should have, perhaps, and received inadequate return to do so.
So would you pin that on the Fed for keeping rates too low for too long? Or would you say that is just a market condition of bull market in general and easy money going for far too long?
A little bit of each. I don't think that the Fed kept rates too low for too long. I think they kept them low. But they had to ensure that our economy made a comeback. You know, in my new book, I talk about the global financial crisis at length. And I say that we've made a nice comeback from the global financial crisis. But I hope that investors won't take away the wrong lesson, because they could conclude, well, obviously what history has showed recently is that we can fix crises, that the Fed and the Treasury know how to pull us out.
Right.
And that's the wrong lesson.
What's the lesson?
Well, the lesson is that these things are dangerous. And in this case, if they hadn't done the right thing promptly in huge scale, and if it hadn't worked, we would now be in a depression, in my opinion.
Okay. So does that mean that when the next downturn comes, because there is a next downturn, we have not repealed the economic cycle, that there are going to be a lot of unhappy individual investors who went out on that risk scale who maybe don't realize what they've done?
That's my general position. I used to tell the story, not quite so relevant anymore, about the guy who's sitting in his undershirt watching the Super Bowl, and he gets a statement from Fidelity, and it says, the yield on your money market fund is now zero. The yield on your intermediate treasury fund is now zero. And so he picks up the phone. He calls the 800 number. He says, get me out of those funds that yield zero.
Right.
And put me in the one that yields 6.
Right.
And he becomes a high-yield bond investor.
Mm-hmm.
He doesn't know what that means. He doesn't know what risk it entails, but he knows that 6 is better than 0. And I think that that's an extreme description of pro-risk behavior. And one of my beliefs is that there's nothing wrong with taking risk as long as you do it intelligently, as long as you understand the risk and understand the importance of mitigating it and how to do so.
Right.
What I just described is not the intelligent bearing of risk. So I do think that money was forced out of the safe asset classes into the risky asset classes, where maybe there was too much money chasing too few deals. And the result, as I say, is bad decisions.
Okay, so we covered your top 3. Let's go to your 4, 5, 6 tenets.
Okay, number 4 is a high degree of specialization. So we don't have a central research department. Each strategy has its own research department. Each person is dedicated to one strategy. We don't have jacks of all trades. And each fund does one thing. So if somebody comes to Oaktree and they want an XYZ fund, high-yield bond fund, as I say, I started at Citibank 40 years ago, and our high-yield bond portfolios in 40 years have never owned anything but a high-yield bond. That's not true of many funds. Many funds have some commons, some preferreds, some distressed debt, some munis, some sovereigns, other things to goose the return.
Is that because they got too big, or is it simply to goose the return?
Well, I think it's to goose the return.
Okay.
Back when I was at Citibank, my boss said to me, I was running convertibles and high-yield bonds. He says to me, why don't you put some converts in the high-yield portfolios, because the stock market strength could add to the return. I said, well, I think that's a great idea, and I'll also put in some gold and some old master paintings. We believe in giving the client what they asked for, and if they want something else, we'll give them that too, but it should, again, be a knowing, conscious decision.
Interesting. Okay, specialization. What's number 5?
5, to me, is one of the more interesting ones. Our investment actions are not governed by macro forecasts.
Okay, that's really interesting because so many firms have that super duper economist who speaks to all the clients and says, let me explain this to you, Mr. Klein, Ms. Client, Ms. CFO.
Let me tell you what's going to happen next year.
Right, and why do you not do that?
The macro outlook is very important. Macro drives the markets these days and has for the last, 15 years. I think macro took over from micro some time ago. But I don't think it's knowable. We don't have an economist at Oaktree. We don't have economists in. One of my good friends who is an economist who I started working with early in my career, which probably means the late 60s, called me a couple of years ago and he said, you know what, you've changed my life. I said, how is that? He says, because I've stopped making forecasts. I tell people what I see going on. I tell them what I think it means. And that's it. The point is, most forecasts are extrapolations. Everybody agrees with them. If they come true, it doesn't make anybody any money.
Right.
The forecasts that would make people money are idiosyncratic forecasts of deviation from trend, and they would be highly profitable, but they're rarely right. So what that says is that, to me, that you have consensus forecasts, which are usually right but not profitable, and idiosyncratic forecasts, which are potentially profitable but rarely right. why do it? Why go to the trouble?
That's so interesting.
And to put it in slightly different terms, but really saying the same things, the goal, as you know, is to be a superior investor. If we are not superior, we have no edge. We have no reason for being. It has to come from seeing things differently and doing things differently and having a superior insight. And I just don't believe that it's possible to have a superior insight in the macro, which is economies, markets, currencies, and rates.
Mm-hmm.
We spend all our time trying to know the micro, companies, industries, and securities, and doing so better than others.
Okay, we will get back to our interview with Howard Marks when we just get back from this brief break. During the break, hop onto JillOnMoney.com and bookmark it, because there you can read, listen, watch, and you can pre-order my book. It's coming out so soon. February 5th is the drop date. The Dumb Things Smart People Do With Their Money. Check it out. Go to JillOnMoney.com, click on the book link, and you can get it. All right, we'll be right back.
Do I invest here? Should I put my money there? Jill Schlesinger can help you. Back to Jill on Money.
You're back with Jill on Money. Have you missed a bunch of our shows for some reason? Well, don't worry. You can just go onto the website and get them. You can also subscribe to our podcast. It's called Jill on Money. Get it? This is Jill on Money, the radio show. And then there's a podcast called Jill on Money. And the cool thing about doing those two different vehicles is that you get slightly different pieces of information, slightly different kinds of interviews. You get more Jill all the time, and more Mark, of course, because with Jill comes Mark. We're a package deal. All right, let's get back to our interview with Howard Marks. In this segment, despite the name of his book, which is called Mastering the Market Cycle, Marks is not a fan of timing the market. Here's more of our interview with Howard Marks. We do micro, not macro. Was that 4 or 5?
That's 5.
That was 5. What's a 6?
We're not the kind of people who go in and out of the market, cash, no cash.
Long term.
Yes, very, very hard to do that right. If you go from an asset, let's say high yield, you sell a high yield bond that yields 6, you put it into cash, it yields 1, you better be right away. And it's very hard to do that right away. And then, by the way, you have to get back in at the right time. It's very, very hard to do that.
So in your new book, Mastering the Market Cycle, Getting the Odds on Your Side, you are not advocating market timing.
This is semantic.
Okay.
I think market timing is what I just described.
Right.
Getting in, out
Yeah.
for the short term based on predictions of what the market's going to do.
Right.
And I think that's very hard to do. I don't advocate that. What I think is very important, and what we do and have done with good success, is that we alter our offense versus defense. Again, not based on forecasts, but based on observations regarding the here and now. Mm-hmm. So, for example, if I see that the market has been strong, that valuations are high on the back of pro-risk behavior, that tells me, I call this a process called taking the temperature of the market, and that tells me that we should be cautious, more cautious than usual. And that's what we have been for the last few years. If the market goes down and stocks are statistically cheap and everybody's suicidal and everybody's saying, that's it, I'll never take risk again, I say, okay, that's the time that we should get in, because probably there's no optimism cooked into the prices of stocks. That's probably a time we should move forward.
And I think that that's really important because, when we hear from individual investors who call into the program, they'll often say things like, well, I'm just so nervous about stocks, I'm going to get out of every stock. And I say the same thing, you're going to have to get 2 brilliant decisions, right?
Sure.
And now it's different than, hey, you know what? I'm playing defense. I made a ton of money in the stock market over the last 9 years. My position is swollen.
Right.
I used to be a 70-30 kind of investor, and now I'm 90-10.
Yes.
What is the advice that you would give to sort of the journeyman investor who's got $500,000 in non-retirement assets and $1 million in retirement funds, managing his or her own money? What is the advice that you think that person is not receiving, or what is the strategy that person's not executing?
Well, it's multi-layered. But let's take the person you're talking about. I'm nervous. I want to get out of the market.
Right.
Why are you nervous? I'm nervous because everything I read is negative. Everybody else reads the same negative stories. They're nervous too. The price of the stocks reflects their nervousness. That means it's probably not a time to get out. Maybe it's a time to get in. Most people sell when they're nervous and prices are low, and buy when they're confident and prices are high. Now, I was taught, I always say, my mother said, Howie, buy low, sell high. But most people buy high, sell low. So the first thing to notice is the importance of not doing so, the importance of not succumbing to crowd psychology, the importance of controlling your emotions. Doing what most people do, which is buy high, sell low, is the worst thing you could do. It's much better to just buy and hold. For people who can't make a superior decision on what I'm talking about, which I call cycle positioning, then I think that buy and hold is better than the default psychology of following the herd. Still better if you can do it, if you can devote the time and effort, if you have the experience level or have read enough, and if you can get your emotions under control. Still better is to buy when everybody else is nervous and sell when everybody else is euphoric. And that's really what the book's about. So that would be cycle positioning. Now, the other thing I want to mention based on what you just said, I've had a great ride. I've made a lot of money. My portfolio has gone from 70-30 to 90-10. Okay, so here's my question to you. Based on where we are, not making a guess about where we're going, are things as attractive today as they were at the start of that 9-year period? And
No.
the answer is the S&P has quadrupled. The easy money's been made. The market may go up for the next 2 years. I'm not saying it's not.
Right.
But certainly it's not going to quadruple again in the next 9 years.
Right.
So that tells me that you shouldn't have as much risk today as you had 9 years ago.
So essentially, even if I were to say, okay, I have to rebalance.
Yes.
I'm going to be back to 70-30.
Yes.
You might even argue, given what has just happened, that it shouldn't be 70-30,
Right.
it should be 60-40.
Exactly. Now let me put it in my words for your listeners.
Okay.
Think of this as a speedometer on your dashboard. Goes from 0 to 100. 0 is all cash. You're terrified. You think the market's falling apart. You think that nobody else has figured it out yet, so prices are high, so you get out. You go all to cash. Can't lose money, can't make money. 100 is fully invested in aggressive assets and maybe using some leverage. To do that, you would have to say everybody else is suicidal and the prices are on the floor, so it's worth taking max risk. I can't imagine ever being at 0 or 100.
Right.
But the first thing that every person should do, and I doubt many people do this, or even perhaps organizations, is you should say, where should my normal risk position be? It depends on who you are, your age, your financial condition, your earnings, how your earnings relate to your spending. Are you making more than you need or less? How many dependents do you have? How old are they? What are their needs going to be? What is your emotional makeup? What is your ability to bear risk and hold on through tough times, which is the most important single thing in investing?
Well, thank you so much, Howard Marks, for coming in and spending time with us. His book is called Mastering the Market Cycle. We will have a link to the book, and you'll be able to buy it if you'd like. Just go to JillOnMoney.com and click on the listen link, and you'll have the link to our show notes. Okay, when we return, we're diving into your questions. It's Jill on Money. Send us an email, askjill@JillOnMoney.com. We'll be right back.
Follow Jill on Twitter and Instagram for more personal finance content. Just use the handle @JillOnMoney. Now, back to the show.
You're back with Jill on Money. And if you've got a financial question, we would love to hear from you. Just email us, askjill@JillOnMoney.com. Askjill@JillOnMoney.com. You can follow us on Twitter @JillOnMoney and Instagram, which is also Jill on Money, and Facebook. Isn't Facebook now Jill on Money? That's my fan page, which they made me convert to. So I don't know what happens to all my high school friends. I'm not sure exactly what's going on with any of this, but Mark's taking care of it, which is great because I don't do anything when it comes to that. He just manages my life, which is good. Soon I will be, Mark, soon I will just sort of assign you to take care of the other parts of my life. Just take care of everything. He's the best. An executive producer does that. Just takes care of your life, your work life. It's the most amazing thing. So lucky. All right, here's an email from Michael who wanted to get a free credit report mailed to him and never received it. He goes, I've never requested one before. Is there a way to speak to a real person? I hope that you are asking for the right thing because I'm hoping that means you went to annualcreditreport.com. And if you've done that, I think that that's the way to go. He says he's hesitant to request one online due to the scams that are around. So, all right. So go to annualcreditreport.com. That's what I would do. And the other part of the question is it a good idea to purchase protection? Meaning probably some, I think surveillance protection, $30 a month. A month? Isn't it a year? It's to notify the buyer if someone's using their information. Absolutely not. Do not do that. Mark, let's make sure that we put in the show notes a link to the article that we wrote after the Marriott Starwood data breach, because we've got some best practices there after we talk about it. But no, those things are not really worth it. What you want to do is you want to actually be monitoring yourself. And I think that something that became quite apparent to me during this whole fiasco, yet another data breach, we should all presume forever that our information is out there. It is impossible to understand how you versus the millions and millions of people who were affected were not impacted. So let's just again say you are likely dealing with a situation where someone's got your name and your address or access to it and can access it, and that is going to be an issue for you. Okay? Just accept it. Then go about and start protecting yourself. That, to me, is the most important thing. Okay? Whew. Here is another email from Donna. I had to take early retirement 3 years ago due to my health. I took my retirement account and I put it into an IRA with Fidelity. In the meantime, I have an interest in a home. I have a high interest home equity mortgage on my home. It was a bad idea. I was helping my son who never paid me back. Boy. Oh, okay. In general, so you should know, my first mortgage has a low rate. The high interest is on my second. Should I refinance with a low interest or pay off my home with my retirement? I owe $80,000. I have $200,000 in retirement. No way to replenish it. Well, that's an easy one. No, you cannot use your liquidity up. Absolutely not. Do not do that. What you should do is you should tick off and make every possible arrangement to pay off that second mortgage. And I don't even think you should refinance. I don't know if you should even refinance at this point. It depends how low a rate you have on the first versus the second. So I need a little bit more information. But one thing I know for sure is you absolutely positively cannot take the liquidity that you have in that IRA rollover. Okay? Then that's what you do. Okay. Stephen writes, I've not paid into Social Security for a number of years. I'm self-employed. Can I start again? How do I calculate how much to pay? Is there a website that can do this for you? I presume, you would be paying, you would have to be paying Social Security if you were paying yourself a wage versus just business income. So what I would do is I would talk to your tax preparer or an accountant to help you out with this. That's what I would do. And I think that would be the smartest way to proceed. Okay? Here's a quick one from Ann before we go to a break. Hi, Jill. Is it wise to roll over my IRA investment into an IRA that is invested in silver to hedge against a possible recession? Now, I don't know what that means. Present IRA into a silver IRA? What does that mean, Mark? I don't know if she means the name of the account is called a silver IRA or whether she's investing in silver. Anne, I need more information. I don't know what a silver IRA is, unless you mean, if you mean, do you invest in silver? The answer is no. If you mean, are you trying to invest all the money that's currently invested in some sort of very safe investment? Maybe. I don't know, but I don't know how old you are. I don't know what else is going on. We need more info. Okay? It's very hard, Mark. Sometimes I get these questions. I get worried about people doing stuff. Okay. If you have a financial question, we would love to hear from you. The way you get in touch with us is go to our website, JillOnMoney.com. Click on the Contact Us button. And if you are an old school email user like I am, send us an email. Ask Jill at JillOnMoney.com. We'll be right back. You're back with Jill on Money. If you've got a financial question, we would love to hear from you. Just so easy. Send us an email, ask Jill at JillOnMoney.com. Hop onto the website, get the information. While you're on the website, then you can basically find all the great stuff that we do. You can read, you can listen, you can watch. Sign up for our free weekly newsletter and pre-order your book. How about that? Next month it comes out. Hurry up. Okay, here is a question that we received from Anna, who's got a dilemma. Her stockbroker, her estate attorney, and tax advisor don't know the answer to this. Already I'm worried. I probably won't either. My father died in November of 2017, and our rep at the brokerage firm didn't provide documents to transfer the IRA to my mother. She died 7 weeks after my father in December of 2017. Oh, what a horrible story. Okay, because the reason why that's important is normally what would happen is one spouse would transfer the money upon death. It just would slide right over to the surviving spouse. But that never happened. Okay, now, Anna was listed as a contingent beneficiary, but it's worth over $800,000 and it's now in probate. My intention is, I don't know, why is that in probate if you're the contingent beneficiary? Why is that a probatable asset if it's an IRA account? I'm very intrigued by this. I'm not sure I know the answer at all, though. Anyway, Anna's intention is to create an inherited IRA to receive payouts based on her life expectancy. Good idea. Okay, now I need to know if I have to take out a required minimum distribution this year while it's in probate, or because it's in probate, the RMD is waived. Thank you for any help that you can provide. Very interesting question. Usually, I would say, to be safe, I would obviously get another opinion because it's insane that nobody knows the answer to this. But usually, if you're a non-spouse, you get to delay some things. But I would say this. I would take the RMD for the year. That's the safer way to do it. Tax rates are lower. And so I know that it might stink if you didn't have to in the first place, but I probably would do that. But I really would consult a couple of other professionals to give you guidance on this. All right. That's it. That is the end of the show. Thank you so much for listening. And remember, all week long, when you have questions that are burning, just send us an email. Ask Jill at JillOnMoney.com. We'll see you next week. Take care. Bye.